Hello, this is Manesh Patel with Ichimoku Trade. Today is June 8th, 2016. We got another one of our great trade reviews today where we're going to talk about how we got a 3-to-1 reward risk ratio overnight on a instrument called PAY. One of the things that we do in options universities teach people how to do what we call pre-earnings strategies. Take trades right before earnings. It could be 3 weeks earlier, 2 weeks earlier, 1 week earlier, or even the day before. The strategy we're going to show you today on how we took PAY is where we took a trade right before earnings. PAY had earnings last night after U.S. stock market hours, so we put the trade on before the market closed and basically listened to the pre-market after earnings announcement. And this morning we should be profitable with over a 3-to-1 reward risk ratio. So let's step you through exactly what the process we went through to find this trade and then how we executed it based on technical analysis and also based on option analysis too. Before we begin, let's go for our normal disclaimer to state this is for education use only. We're not soliciting you to buy or sell any particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group, cannot be copied or distributed without our written permission. We are broker neutral, so we do support various charting platforms out there from TradeStation, eSignal, Thinkorswim, and so forth. Anything that has an Ichimoku indicator you could pretty much use. Before we begin, here's our contact details down here. You could call us at any of our office locations here, or you could email us here at info@eiicapital.com for any questions or in regards to videos or questions on what we did or anything like that. Okay. So let's go through and find out what happened. So with yesterday, we always do this. We always scan during the day in the market hours for any earnings announcements that's going to happen after market or pre-market the next day. Okay, and then what we do is we use Ichimoku to determine exactly which way it's going to go and look at the probabilities. One of the things we also do is look at seasonal patterns during this process. So we go to this application here. There's a website here, but this is also available on the mobile app. This is something that we created ourselves, and it's free to the public too. So this is alerttrades.com. I'm going to log in. It's free to register and log in. So I'm going to log in, and the very first thing we did was we scanned all the instruments that basically had earnings after market. So the first one, well, this was I think the third one we looked at was PAY. Out of all the instruments out there, the only one that really exhibited nice seasonal patterns was the instrument PAY, P-A-Y, which basically is Verifone Systems here. And if you look here, this had an 80% chance of basically being bearish, and this basically, out of the whole move, the entire year, 14% of the price action for the entire year occurs in June. So you know this instrument's going to move. And then if you look here, it has an average movement of 12%. That's pretty big. And if you look at all the years here, it typically moves a lot, especially in the last 3 years. This thing has moved on average over 15 or 20% on average over the last couple of years. Okay, in the lowest years, basically it's 2.1, which is against you, but going down, it always at least moves 3.7%. So we're going to take note of the 12% and the 3.7, but notice one thing. Max profit here is 18.2. At one point it was 34% down. Another point it was 20% down, and so forth. Okay, so I really like these numbers. Reason why is we are trend traders. We want to look for trends, and this instrument, based on what has happened in the past, has a high probability of repeating that volatility and everything moving forward. Okay, now it doesn't mean it guarantees anything at all. There's no guarantees, so we have to confirm this with technical analysis. But I want you to pay attention to one thing. One, minimum downside movement is 3.7, average is about 12, and max is 18%. Okay, so now what I need to do is I need to confirm this with technical analysis to see exactly what's going on. So here's an Ichimoku chart here provided by eSignal Interactive Data. This is PAY. This is the monthly time frame. Whenever I'm looking at earning strategies, we're looking at higher time frames, either weekly or monthly. Okay. If you look at the monthly, you could see clearly it's below the cloud and it's also below the green line. Based on Ichimoku, that's telling us basically we should be going short. Do not worry about this red line here, because this is short term here, and really earnings could blow away the red line. So really what you need to do for earnings is concentrate on the cloud and the green line. So the monthly is definitely telling me it's bearish, and that's long term, which is exactly what I'm looking at. And the reason why you're looking at long term charts is because basically, if you think about it, right, when the earnings comes out, that typically starts a long-term trend, and that's why we look at weekly and monthly charts. If you look here on the weekly time frame here, this is below the cloud here, but above the green line. Since this is below the cloud here, you're going to be betting on it going bearish, and minimum it should at least get to is here, which is that green line here. And if you look at the percentage movement here, our market close to here, you're looking at right here is a 11.44% movement down. Okay, and if you remember on earnings on the seasonality, it says an average of 18%. So if I look at this and say, okay, you know what, if it comes down to here, retest this low here, this is 23%. Where's 18% would put you right about here, which will fall short of this pivot low. To get to that pivot low, this will be roughly about a 25% movement. Okay, so these are the numbers we're looking at here. Minimum I could see this at least getting to is the green line here, which is 24.90. So I really need to make sure that when I choose the options here, I'm looking for a worst case scenario, which is getting to here. If it gets below there, it's bonus for me completely. Okay, so now what I'm going to do is I'm going to look at an option chain analysis. And what I'm doing here is, here's the option trades here. Let me go to the option analysis here. Here's pay. If you look at pay here, you can't see much right now. The volatility is extremely high, if you notice that. That means you can't really buy calls and puts. And if you look a couple of months out, you could see volatility is high way out later on too. So that tells you that you can't buy a single call or put. You literally have to take a strategy that has a sell leg attached to it. So what we're going to do is we're going to sit there and look at a vertical spread. Okay. The other thing is that if you buy a call and put and you look at the deltas here, you really don't make that much at all. Look at this here. You can't really see it here. Let's look at this one here. Notice the spreads in here. Okay. If you look here, I'm going to make 50, 60 cents. This is going to cost me 60 cents. The delta in here, oh, they've blanked this out. Let's look at this one. Is 23 cents. Okay. And if you think about it, we're dealing with a stock that was around $28. A 5% movement on this stock is going to be roughly, let me calculate that. Stocks on average move 3 to 5%. So if you look at this thing here and say, okay, you know what? It's going to move an average of 3%. On $28, a 3% movement is only 84 cents. That's not even a whole delta. So that's not even worth me sitting there buying calls and puts. So I really need to look at a vertical spread. So we actually sat there and took a vertical spread on this guy here, and you could see the spread here. And remember, our technical analysis said that the bottom part is at least is going to sit there and get to that green line. Okay, and let me show you that again here. Here, whoops, right there. At least it's going to come to here, which is going to be about the green line here. That means $25. Okay, so that means so 25 is my sweet spot here. So I looked at a vertical spread and made sure that at least when it gets to 25, I'm going to be at my max point here. Okay, and if it breaks that green line, I'm going to go way in the money here, which is perfect, exactly what I'm looking for. And the good thing is, if you think about it, I'm doing June options, and option expiry is next week. So I don't have much time at all. Quickly come back here. If you look at this trade here, basically we took 2 contracts here in our student account. This was worth $42. And if you look here, we're going to sit there and get to about 158. Okay. So this right here, if you think about it, is almost a 4-to-1 reward risk ratio. This is over 3-to-1. Okay. And what the best part is that yes, we have a couple of days to expiration. So let's say it gets to here. If it gets to here tomorrow, then basically that's a 3-to-1 reward risk ratio. So if it sits there and gets to our $25, $25 spot here, and then bounces off there and comes up, we're at least going to sit there and make a 3-to-1. If it gets below 25, we're going to get a 4-to-1 reward risk ratio, which is exactly what you want it to do. Okay, and so this is basically how you sit there and get a residual income. You're looking for a 3-to-1 reward risk ratio, and you can see the trade here. Let me put a here so you can see the view trade. You can see that we put this on before lunchtime yesterday here. You can see that the buy leg here cost us 39 cents. The short leg here was 18 cents. So net, if you look at it here, each one of these contracts cost us $21. Okay. Now you don't want to do a huge amount of contracts here. Reason why is this is a do or die situation. Okay, when you're sitting there trading these earning trades, because if it goes bullish, you're going to lose every bit of value in this instrument. So what we're doing is we're trading probabilities here. You want to keep your risk low, okay, and you want to make sure you have a 3-to-1 reward risk ratio. So what happens is that if you consistently keep on doing these earnings trades here, all you have to do is be right a couple of times, and it takes care of all your losing trades, and net you walk away being profitable. So in this one, on market open, if you look at the current price of this instrument here, it's roughly in pre-market trading around 2023. So this is way below our max point here. So we're right here. So we should be a max profit pretty much by the end of at market open today. So we could leave this trade on to expire till next week, or we could even close it out with very little, buying it back maybe for 5 cents or something like that. Selling it for 5 cents or something like that. Okay, that completes our trade review for today. Hope you guys enjoyed it. Again, if you have any questions, you're more than welcome to give us a call at any of our office locations here, or email us there. Thank you and have a good day.